Welcome to Capitalizing Your Life, the podcast that shows you how to take control of your money, build lasting wealth, and create financial freedom using the infinite banking concept. If you're ready to make your cash flow work for you instead of someone else, you're in the right place. Here's your host, Glenn Yaney.
What's up and welcome back to another episode. Today I have the famous Glenn Yaney. Glenn, it's good to have you here, bro.
Always excited to be on and love having the conversation with you.
Yeah, I think we have a lot of conversations that we're going to create quite a few podcasts with this. But today we're talking about, look, if you're invested in real estate, that means you've had a relationship with a bank, whether it's good or bad. You had a relationship. And they talk about something called a balance sheet. And Glenn is heavily invested in different real estate projects, which we can talk about. And we're going to talk about balance sheet items that can help him create more real estate investments. And now there's some things on a balance sheet that can hurt your ability to create real estate investments or not provide any value. So Glenn, I'm stoked to talk about balance sheet items today.
Yeah, I love it. And really, after I would say 5 years of solid getting our books in order for real estate, going to banks, trying to get loans, large loans, $2 million at a time. I would say one thing is totally off topic is that having a very organized financials is very helpful to the bank, that they just don't kick you to the curb, because I've had that experience as well. But the other one is having a strong balance sheet along with that, because we're actually in the middle of 3 transactions right now. We have 2 refinances and 1 purchase going on. And I can tell you, because of our balance sheet today, I feel very confident and not concerned about the closings of the refinances or really the closings of the new purchase, just because focusing on a solid balance sheet gives you confidence to make offers, stronger offers, to, flex, really, to be able to buy assets at a better price, because you can close, you're making stronger offers, because whether you're paying cash or have things in place to know that you can close is the key.
Yeah, and you mentioned this in one of the other podcasts of having access to cash, and you never wanted to be the person who used to have 600 doors.
Yeah.
But you want to be able to keep those. And so the challenge when it comes to real estate is people getting over-leveraged and overexcited and ignoring this balance sheet. And balance sheets can consist of a number of different types of assets. So when you talk to the banks, how does this conversation typically go?
So they always want to see where your cash reserves are. And what I love about, cash value is that they give you 95% of the value. So if I have a balance sheet item that it seems very boring until the banks ask you for those line items. And so they ask for what's called a PFS, which is personal financial statement. And real quick, before we go any further, as you were talking, I was realizing, like, when me and Matt were talking before this a couple months ago, when we started talking, I think that was the thing I pointed out to him. I said, it's my favorite balance sheet item. And it's because of the security and the certainty that it creates in my life to be able to make moves. And I can tell you that there's experience that's happened up to that point that's made me give more value to having a strong balance sheet. And for people that are deciding on buying real estate or even starting a business, it's like, these are things, the reason why the banks care about how much cash you have available is they're not looking to take away those assets. They're just making sure that you can pay for the mortgage that they're lending you. The banks don't look to take the asset from you.
Yeah.
They're just making sure that you're going to pay the loan. And that's really what having strong, cash available on your balance sheet. And I've gone down this rabbit hole of like failures or successes through trying to create liquidity in my life to continuously buy real estate or make, promissory notes or whatever the case be. And yeah, it starts with the first one it started with was, borrowing against my real estate. So I had a house that I put a $50,000 line of credit on, and I took that $50,000 line and I ended up buying another single family home. That single family, what it does, what I would tell you the problem is with real estate is that when you borrow against the real estate, you have to pay it back on a time schedule, which is understandable. But at the same time, you're creating a higher debt on you. So it's harder for banks. They see that you're increasing your debt to buy more real estate.
So you're increasing your debt to income, and that shows up on every credit report.
Definitely. And it's one of those things where I got myself into a position where I had to search for liquidity after I maxed out my line of credit, is what it ended up doing. And it was the beginning of me raiding the 401k funds. It's really what
Which
happened.
turned out to be a good thing because you got really creative and paid no tax on that distribution. You paid the penalty, but there's some creative ways to get money out of the 401 so you could do what you're good at, which was real estate. But this is good though. I like where you're going with this. So having that access to liquidity was crucial. And so when banks look at the cash or cash equivalents, there's a difference between, it's like cash versus cash value is very big. But before I go there, I'm sorry to cut you off. You mentioned, so you had your home and you had equity in the home. You opened a line of credit, which they check your credit report. It'll show up on your credit report, and you have repayment terms. You have to pay them every month when you use the credit. But the good news about what you did is that you used debt equity in your home to go buy a cash flowing asset in ways that the IRS incentivizes because the interest is deductible.
Yeah. So the thing about lines of credits is that you're still dealing with the banks. Like I have a current line of credit that the bigger the line of credit, the more financials the banks want, and more frequently the banks want the financials. So
to prove your balance sheet, to prove your liquidity?
To prove your liquidity, like whether you own a business, lots of businesses, as you grow a business, you're going to need a line of credit. And that's the reality of it, just because you're trying to grow a little faster than what your current status is. So for me, I was trying to grow my real estate portfolio. But if you're selling items, you're going to need more items to sell to be prepared to buy more. And really it's when you have, like I've had friends that have a $5 million line of credit and they have to give monthly financials to keep that line of credit open. And if those financials aren't there, they can cut back the line of credit. And I think when you get to that size, you kind of become reliant on this credit and you become addicted to it is what happens. And when the banks decide to shut it down, they're not really checking to make sure that you're okay with that. They just shut it down and then you have to figure it out. Like, okay, maybe it's not a line of credit where you're paying interest only now. Now it's gone amortized. So then it becomes a more aggressive loan where say if it's a $100,000 loan, you're paying interest only. It's probably like $600 to $700 a month. It turns into like $1,000 to $1,200, and you don't have any liquidity anymore. So you've kind of created a problem for yourself. That's been my experience with banks and lines of credits, and they're always checking to make sure the collateral is good.
Well, yeah, because they know what they're doing.
Exactly.
One of my old neighbors up in Michigan was retired, but he was a business owner that sold his business. And in 2008, when the housing market was collapsing, he had a line of credit through this major bank. I'm not going to say their name, but you've heard of them, for millions. And they called the loan. He had never missed a payment, but they called the line of credit. They said, no more. We are keeping all the capital in-house. You no longer have access to a line. So who's going to control in that situation? The consumer or the banks? Always the banks.
Banks, yep.
Now, if I had cash value inside of my life insurance, so in your home example, your equity was in the house.
Yep.
In life insurance, I have equity in my death benefit and cash value. The equity is the cash value. If I were to leverage the equity of my life insurance, there is no credit check. There is no credit reporting. There's no loan repayment terms. They can't call the loan. Why? Because if I don't die while the loan is outstanding, I will die after I pay it back, and they already owe me the death benefit. So I'm collateralizing my dead self to go buy real estate or investment opportunities. And the amount I can collateralize is the cash value. That's my equity. So I always joke with people, I would rather have equity in my cash value life insurance than equity in my home. Because the equity in my home really doesn't do much for me. And if I do, the banks are still in control.
Yes. The more equity you have in that house, the more control they have over you. For sure.
That's scary too, because think about this, dude. If you have a $500,000 home paid off, you have a $300,000 line of credit, you take out the $250,000 and you can't make the payments back, they don't take half the house. Now there's legal rules here where you could probably delay it and you'll have some options, but they get the entire $500,000 even though you only took out $250,000 in credit. And the life insurance, if I have $1 million death benefit and $250,000 of cash value or equity, if I take out the $250,000, when I'm gone, it just comes off the death benefit. So sorry, honey, you don't get $1 million, you get $750,000. Tax-free. She'll probably be okay. And this is more of the reasons why as family, people who if you don't like your family, you wouldn't do this, but I'd rather have equity in the life insurance because if I die, my wife gets millions tax-free.
Yep.
She could pay off the mortgage. She can get rid of the bank as soon as I'm gone. I'm literally buying my net worth and then leveraging that for cash flow assets. And back to the point, I know I was going to just bring up balance sheet again, like cash value, life insurance shows up on the balance sheet and it's guaranteed to grow. And historically, it's grown hundreds of times better than a typical savings account does. And it's tax-free.
So what I'm doing right now, I was talking to you about a few refinances. So it actually is interesting because one refinance, we're not pulling any money out. We're just getting a lower rate. We're increasing our cash flow by literally 1/3. Like we're doubling our cash flow on the properties.
Let's go.
And yeah, it's great. So we actually borrowed a lot when we bought them. So we weren't able to really pull money out. But we have this other property we bought. We paid $150 for it. And we put about $100,000 into it. So long story short, the loan was $100,000. And so we're pulling out $330,000. And what I'm doing with the cash is pulling out of the property and putting it directly to pay off loans on my policy. And it's not to pay off the loans, but it's just to create more available capital for the next, like when it comes to a refinance, the banks ask less questions when you have a lot of cash on your balance sheet or liquidity. And then the other thing is that back to the story of the person that files bankruptcy isn't the person that has too much debt. It's the person with no liquidity. So we're focusing on building out liquid assets, creating cash flow. Obviously, want to be safe about it. But I mean, that property that we're pulling out, about $230,000 out of it, that property's still cash flowing about $1,000 a month. But what we're creating is a bank that's becoming a private investor of ours. So the interest rate will be around 7% with the bank. And now we're going to have a loan against the rental property. And now we have a lender, which is a bank that I see as an investor. So they become 7%. That's all I'm paying this investor. And I can go buy assets that are making, 15 to 20% more. And ideally 15% cash on cash. And that's really the purpose of us doing this is we're taking the money out. Yeah, we are increasing our debt, but we're also going to be buying a 11-unit mobile home park with the $200,000 that creates more income overall. And that's really the process. We're just trying to create more income, spread out our risk over more units. And instead of having 2 tenants paying the debt service, we're going to have 13 residents that are going to be paying the debt service while holding on to as much liquidity as we possibly can. Hey guys, if you'd like to learn more about the infinite banking concept and how to flow your capital through your own financing system, my team and I are here to help. With over 35 years of experience, we can guide you in building a properly structured whole life policy tailored to you and your family. See the scheduling link below. Now, back to the show.
So what you're talking about is kind of referred to as debt restructuring.
Yep.
Because I would argue that even though one property you're going into debt more, the equity is put into another property. So you're just restructuring the equity. The equity in your net worth might even be higher based on the new property that you purchase. But it's just moving where the equity is. You're creating another asset using other people's money, which is incentivized by the IRS. And this is what's so valuable with insurance. Used properly, not only does it show up on a balance sheet, it's liquid. It shows the bank you have the ability to repay them if you need to. But heaven forbid something terrible happens, your wife's going to get a big old check to help buy out your partners, to buy off properties, to do whatever she wants with. She doesn't have to do anything with it. And moving the equity from property, I found that interesting. You said you're going to take a HELOC or a line of credit on a property and move that equity into your policy. Now, if you wanted to get the equity out of the policy, you don't have to deal with the bank.
Yep.
The insurance company can't call the loan. There's no credit reporting. There's no credit score adjustment. In fact, you don't even have to make monthly payments back to the insurance company, do you?
Yeah. I mean, we encourage it for sure to make payments. But at the same time, really what I'm doing, I have about a $60,000 premium that I'm paying in July. It's due in July. I'm taking that $60,000, paying it, and I'm going to borrow it right back out, and I'm going to put it into some CapEx projects. So what's happening is I'm growing out my cash value that's growing uninterrupted, and I'm taking a line of credit against my cash value, putting it into real estate. And what that CapEx does is it's constant tax advantages. So I'm taking $60,000 and it's probably going to be 100% deductible in the first year. So now I'm able to borrow this $200,000. I have to split some of it with partners, getting about $60,000 out, put it into my cash value, growing out the cash value, borrowing against the line of credit against it, which is cash value is still there. It's not going anywhere. It's growing uninterrupted, compounding, tax-free.
Inside the policy.
Go ahead.
Inside the policy, it's growing.
Inside the policy. So then I take this line of credit that's contractually guaranteed by the insurance company, take it out, put it into this real estate property, and I'm able to receive a tax. It saves me taxes due to the capex, the depreciation, and all this stuff that's happening. So it's just spreading out my risks with debt, also while growing out my own family banking system, keeping a safe, liquid location where I can store my capital. It's creditor protected. It's what is it when you can't be sued? It's
litigation proof.
yeah. It's
Depending on where you live. I mean, if you're on the left coast, sorry, it's not as protected over there.
thankfully in Florida. So it's a very safe place for your capital to be, because when you have a place that's like a bank account, there's things that can happen, and there's ways of audits and all these things that could happen that become a place where people like to go after. It's just like, where do the bank robbers rob the banks? They go after where the money is. So if you're putting money into a properly structured life insurance product, you're getting liquidity almost immediately, and also it's technically no longer your capital. It's just a contractual guaranteed amount that you're allowed to have. I don't know if that's gone too far into it, but you're creating a very safe, liquid place for you to be able to access capital for the next opportunity.
That can show up on a balance sheet.
That's on the balance sheet the banks fully respect.
So one part that you mentioned in there, and this is the key, because I really believe that the order of how our money flows has a massive impact on my ability to create more wealth and take care of my family. And we're not saying don't invest in real estate. In fact, we love these ideas of real estate because of the tax incentives. But by introducing, as I make income, parking that in cash value versus a normal bank, not only buys a death benefit for the fam, but now I can leverage that money out for real estate. If I have $200,000 in cash value, and in your example, you take out $60,000, the $200,000 is still growing uninterrupted. You mentioned this just a second ago. I wanted to make sure we cover it again, because a lot of people miss this part. You're technically borrowing against your dead self. Brian Bloom, a CPA, used to joke about this all the time. You're borrowing against your death benefit up to the amount of cash value. When I borrow against an asset, it's very different than borrowing from an asset. If I borrow against the life insurance, depending on the insurance company, the $200,000 cash value is still growing uninterrupted. They don't recognize the $60,000 that I took out to go buy the real estate. Then people are going to go, well, if you're borrowing, you got to pay interest. Yeah, I'll pay interest on the $60,000 that I took out, but the $200,000 is still earning interest and dividends.
Yep.
This is a simple arbitrage. This is what banks do all day. You ever wonder why a bank pays you, call it 1% on a savings account, and they're going to charge 5% on a car loan? Because they're making the spread, which is a 400% rate of return for the bank, not a 4%. It's crazy how much. When people realize, oh, this isn't about getting rich. This is a simple money move to help my balance sheet to make sure that I don't go broke. Getting rich is up to the consumer. What products are you going to put in place, or investments are you going to take advantage of?
I think the other thing that it's very hard to see as well is that our minds think linear. So like,
It's a good point.
if we think I'm going to put 60 grand in and I'm going to borrow 60 grand out, but what's happening, we're talking about, this is like a 1 to 2 year time frame that we're doing the 60 grand and taking it out. Then we do the same thing next year, and we do the same thing next year, and we do it every year. We're doing, and what's happening with these cash flowing assets or your business as it's growing, it's flowing back into the policy. And what happens is that no longer is it that I'm paying like a whatever $5,000 a month premium. I'm actually paying, $15,000 a month from cash flowing assets that's flowing into my policy, that's giving me liquidity regularly, and it's becoming a safe, liquid asset that I'm able to borrow against at any time. And that 5% is calculated with some carriers. I don't know. You pay the principal first, and at the end of the year, it's calculated, and that's the amount that you're paying in interest. So it's actually a way lower interest rate, even though it's at 5%. It's calculated at a daily rate, but at the same time, you're having more capital inflow, and that principal amount of the loan is going down throughout the whole year. So you're actually not paying a full 5%. So if you took a $100,000 loan out and you're, say that 5%, most people would say that's $5,000 a year, you're actually going to be paying a lower amount as you flow your capital into the policy, because that balance amount is going down throughout the whole year. So you're only paying interest on the actual daily amount that's there.
They call that, I think it's called in arrears.
Yeah.
Wonderful point, because some people say, well, Matt, if the loan from the insurance company is 5% and I can go get a 2% loan, why wouldn't I do that? Okay. So we're thinking linearly,
Yep.
2% is less than 5. All right. What if you're concerned with the ability to repay? What if it's going to take 2 or 3 months before you get tenants in there to start the cash flowing of the rental property? Do you care about having monthly payments that are due? Well, yeah. Okay, then maybe we consider paying a higher interest rate, knowing that if it's in arrears, it's going to go down over the year. But I can skip a few months in repaying the loan, and it doesn't affect my credit score. It doesn't affect them calling the loan. So you have more control. If you wanted to go get a 2% loan at the bank, then so be it. Like, I know a guy, dude, that was up in Champaign, Illinois. Shout out to all the Champaign people. He had got it very well. He had a lot of money in life insurance, and he wanted every 2-3 years he goes to buy a new Porsche. And he said, look, I have enough money in cash value in my life insurance. I can go just buy the Porsche right now, but I don't want to use my cash value. I want to borrow the money. And the way to get a cheap loan from a bank is to prove you don't need the money. When you need it, that's when they can charge more interest. So he posted his life insurance as collateral. The bank gave him the loan, and he got to negotiate the loan rate down to 2%. So he's paying a smaller interest rate. Every single month the payment is due, but now he got a 2% loan to go buy a Porsche instead of paying cash. And when you look at what the growth rate in the policy was, he's making more than what it cost him to go buy the Porsche in interest. So this is just it's a fun math game at some point where you figure out, where should my money sleep at night? Because life insurance is not an investment. It's a fixed account that just so happens to have dividends.
I had this is a little bit off the balance sheet item thought process, but I had me and my business partner were talking about it, and he was talking about the same thing. Like, I could get a cheaper. He's like, we can use our capital to go buy more real estate, and then we can either, borrow a loan against the car, blah, blah, blah. So what I thought about this, and I'm like the kind of person that sees it as, if you have a $50,000 car loan and you're paying $900 a month, you're eating up $900. We'll just say it's tax-free income, $900. So if it was taxable, it might be $1,400. But what kind of asset do you have to buy that pays $1,400 a month? So I still see it as that I would take money from a line of credit and buy the asset so I have immediate access. So say I do create a payment for myself, and it's a $900 payment that I'm paying back to myself. I mean, that monthly payment would be probably about $400,000 to $500,000 of interest, but I'm getting access to that additional $400,000, $500,000 a month in liquidity every month. And this is what we're talking about with controlling our cash flow. Like, if I have a $900 payment, I'm putting $900 in, and I'm not going to pay anything over the $900 until I have the full amount to pay it off, or I'm just going to have something that's eating into my cash flow by $900 a month. And that's kind of the hard part for me to grasp, because I look at what I have to buy to pay for my, like, that $1,400 or that $900 a month payment. What do I have to buy to pay for that? And it's a lot of assets.
Okay, I'm going to go down this rabbit hole with you really quick. Because I have a client that he lends money for land purchases at 12%. Let's do the math on this really quick. $100,000 he'll give out to someone to go buy land. They're going to pay him 12% or $1,000 a month. If he uses his bank account for that transaction, for the $100,000 leaving his bank account, the $100,000 is gone. And how does it get repaid? The interest. Okay. The problem is that the $100,000 that he lent out is only earning in one place, in the loan that he gave out to the consumer. On average, 7 to 8 years in, the land buyer will pay off the note. And in the 8th year, there's about a $95,000, $96,000 payoff. Because as you know, amortized loans, you're paying mostly interest in the beginning. So he goes, well, how do we look at a policy where in the 8th year, if I have a loan outstanding from the insurance company, I'm accruing interest. I don't want him to pay the interest. I want him to use the $1,000 a month cash flow on lifestyle or back into the policy. Let's assume it just went to lifestyle. So he's making $1,000 a month, and then in 8 years, he gets a $96,000 check. Well, he's got a loan accrued from the insurance company that he didn't pay any of the interest. His interest was like $36,000, I think, on the 8th year. Wow, that's expensive. Matt, why wouldn't I just pay cash? According to Dave Ramsey, who does great work right here in Nashville, Tennessee, I'm giving away $36,000 of interest. I said, look at the illustration. What's the dividend? What's the dividend amount in the 8th year? It was $40,000 in 1 year, not accumulated. The 8th year, the dividend was 40 grand, the way that I structured the policy. I said, so when you get the loan, when you get your note paid off from the land buyer, we'll put the $96,000 back into the policy. You'll use the dividend to pay for the loan interest that was outstanding. And he had more cash value than he would have if he just used the bank. By the way, you get a death benefit. By the way, creditors can't touch this.
And really, the only thing that's changing is the way your money flows.
That's it. Well, this is what cash flow architects, we got to design cash flow first, baby.
Yep. Awesome.
Good stuff. All right, balance sheet. When you went out to get properties and they look at assets, you said this in passing one time with me, but did they look at your 401k on the balance sheet?
They did, actually.
Okay. Do you know what happens to you if you were to take the money out or pledge it as collateral?
I can tell you, I've seen some very close people in my life. What happens when you borrow, like when you need your 401k, which there will be a day that everyone does, I believe. If you're going out there, there's times that you underestimate things that happen. I mean, 2008 was a great example of that. But I mean, what I saw, it was this person's lifelong savings was in their 401k. They started losing their house. And then they decided to pull from their 401k to save the house. And then they short sold the house afterwards. So they lost the house, they lost their 401k. And then IRS doesn't care.
No.
They come back later and they say, where's our 40% or whatever the amount is? And what happened is the craziest part about it all is when you need it the most is when you're making the least and you are paying the highest in taxes because you're pulling out all that you can, and you're pulling out like say 300,000 when you're making, when you need the money, and now you're paying at the highest tax bracket you've ever paid. And now what? You're left with a tax bill and no money left over.
Plus the penalty. You have to pay the penalty as well if you're under the age of 59 and a half.
Exactly.
But whoever manages your 401, the brokerage, if you pledge your 401 or IRA as collateral, they're required by law to notify the IRS. And the IRS is going to assume you're going to liquidate the 401k. So they don't even care if you do or not. They assume you do. And you get a tax bill for all of it. It could still be in the plan. The IRS is going to tax you on all of the 401k money. And if you're under 59 and a half, you also get hit with that penalty. So while it shows up on a balance sheet, I think they do it to make us feel good. Okay? Because the advising industry loves 401ks, IRAs, pre-taxed accounts. They can charge fees on dollars that you'll have to eventually give to the IRS. It inflates the fee because it's pre-taxed. So banks also manage retirement accounts. So they might put it on the balance sheet as an item, but you better believe, dude, they are not going to recommend you pledge that as collateral. Worst case scenario, you could get to it, but they're not going to pledge it as collateral because it triggers a taxable event on all of it. Not the portion you pledge, all of it becomes taxable. So as a balance sheet item, it makes us feel warm and fuzzy, just like your 401k statement when you get it in the mail that says you have that beautiful big number on there, and then you say, all right, let me take it all out. 40% is gone.
But Matt, you can borrow $50,000 from 401k.
Okay, this is so dumb when people say this. Fine, I wrote down a word. The most success comes from the people who have choices, and they're not forced to do something wrong at the wrong time. Warren Buffett, when the tide goes out, you'll see who's not wearing shorts.
Yep.
So to your point, I can borrow 50 grand and I'm paying myself interest. You're paying yourself with after-tax dollars, and you're going to get taxed again in retirement. The saddest thing I see is a 45-year-old who has a house they're aggressively trying to pay off. Meanwhile, if they were to miss some payments and the bank forecloses on the house, they don't get half of their equity back. The bank takes the whole house. And then they have their highest net worth is in the 401k, an account they can't pledge as collateral, they can't use, and they might be able to borrow up to $50,000 or 50%.
The problem with the $50,000 as well is that the payback terms are terrible.
Yeah.
We're talking about cash flow, and I'm creating a cash flow bomb for myself. I take $50,000 out, we're back to the $900 payment. Go find an asset that pays $900 on $50,000 and send it my way, because that's where I'm putting my money.
Amen, dude.
But what I'm saying is that because I went down this rabbit hole, I went into a self-directed 401k, or no, it's called an EQRP, where you can redirect your 401k. And long story short, I was like, how do I pull 50 grand out? And they said, well, you can do that, but you're going to have to make a 5-year amortization and you got to make monthly payments. And if you don't make those monthly payments, it all becomes taxable. At that point was when my mind clicked. I said, let me just pull all this money out and I can go do whatever I want with it and I'll just pay the taxes. And I got lucky with CARES Act.
Yeah.
But the second time I pulled my money, I was a little bit smarter with, depreciation and everything. But the first time I pulled it because I was willing to pay the 40,000 or the 40%. And I don't want to hear about what the payback terms are. I want to create my own system.
You mean you want control? What?
Yeah.
How aggressively conceited you must be, controlling your own cash flow. And they have all of these acronyms in the tax code about these different types of accounts: IRA, SEP IRA, 401k, Roth IRA, 403b, 4057, cash balance plans. You could do what's called the 72T distributions, but all of it comes with red tape, and the consumer has none of the control. And the challenge is when you mess that up, the penalties can be really bad. The IRS they know how to get theirs. They're going to get their fair share. I wish some politician would define what fair share means or what rich means, but they won't. They're in control. They're pulling the strings.
So the one more thing we're going to talk about with the 401k, say you do decide the self-directed IRA is the best thing for me. The problem with that is, I'll tell you why. And most people want to use their self-directed IRAs. This is the only time I would say that it might be okay. But I would say if you're using it as a lending tool to be like a lender, that's, in my opinion, that's the only reason why. But if you're using it to buy real estate, there's no benefit in doing that, because the reason why you buy real estate, one of the main reasons I buy real estate is for the tax advantages. And also, you're pretty much losing control. You're giving a property manager control of the asset because you're not allowed to manage it yourself. You can't take direct payments to yourself. It goes right back into your 401k and you still don't have access.
You don't get the cost segregation. There's the reason.
No benefits.
It's still an IRA. It's still a retirement account. And here's what everybody listening, I always go back to this. You do not need a retirement account to retire. You need cash flow.
Yep.
And depending on how you set up your cash flow, that will determine how much you actually get to spend for the rest of your life. How much do you want to give to the government? Some people would say, I want to pay my fair share. I'm all for it. We need roads. If you want to overpay, then go ahead. I just don't want to be overpaying taxes. So to your point, self-directed IRA can give people some control if you do lending. If you buy real estate with a self-directed because you're saving on taxes, get out of it. If you don't spend the money in retirement, when you're gone, your surviving spouse will be a single taxpayer, no longer married, filing jointly. She'll be bumped up into a higher tax bracket because that's the condolence from the IRS. Sorry about your loss. You're going to pay more. When they're gone, that gets inherited to the kids. The kids are required to get that account to zero over 10 years. So it becomes a tax nightmare. You're not saving in taxes. You're actually postponing a tax bill you can't even define. And if you don't want control, have at it. If you're willing to bet and you get what you want and this account's huge and your real estate takes off, you're just creating a bigger problem than you started with. Imagine if CPAs were held liable when they say, I'm going to save you in taxes with your retirement account. And don't come after me. This is just a podcast. This is not financial advice, not tax advice. This is just fun conversation. But when a CPA says that, they're only talking about the year you're contributing. When has a CPA shown you the tax liability at the distribution? Glenn, why do we save money in the first place? Why?
To spend it later.
Eventually, you're going to spend it.
Yeah.
Stephen Covey wrote a little book that a lot of people have heard of. It's called 7 Habits of Highly Effective People. One of the habits is begin with the end in mind. If I get what I want out of this, what does it look like? And I've talked to thousands of people in their 60s, 70s, and 80s that waited until they were 60, 70, and 80 to figure out what the cash flow is going to look like from these accounts. And it's horrendous.
So let's real quick, because I feel like there's 2 more things we really didn't touch base on.
Yeah.
But I think the next one that I think we would hear as a balance sheet item, well, there's 2. The next one is going to be like a taxable stock portfolio.
Yeah, brokerage.
I'll let you go into that one just because I know you're more experienced with it.
What's the other one you're thinking?
The other one, we didn't really talk about it, but is cash.
Oh, yeah, perfect. Sweet, dude. Yeah, we're only 40 minutes in. So taxable account, brokerage account. I'm all for it. Wherever you want your money to sleep at night, I'm good with it. My job is not to recommend. It's just to show you, here's what happens if. You choose. Like, this isn't my plan, it's yours. So a taxable account, some people like the S&P or whatever it might be. I got a great financial guy. He's got no skin in the game, but yeah, I'm sure he's great. Until he's not, by the way, because when the market goes down, pretty much most of them are not doing well. And their excuse is, well, the market's down, it goes up and down. So the challenge with a taxable account is a couple of things. Number one, I do like it. I don't mind it, but I'm a firm believer in the order that we do things. Like, the order that we do it is very important.
Yep.
And I think that if we want to go into securities and a brokerage account, great, but when? I think people skip the safety step first to go experience chasing this high rate of return, this fictitious return.
Yeah.
Look at 2022, for example. In 2022, interest rates were still fairly low in real estate. If I were to pledge my brokerage account, like on a margin, to borrow against a volatile asset to go buy real estate, the S&P 500 dropped almost 20% that year.
Yeah.
The brokerage could call the loan. Then what? Forced to sell the property when the housing market stinks? So the challenge is that you're creating extra risk. That's the quickest way to zero. I had a really good client of mine. He got involved with an IPO. It shot up to like $12 million. So he was set, dude. Set. In my opinion, $5 million, you have liquid in cash value, you are good to go. But this guy had $12 million in stock, borrowed against it. Stock drops. They call the loan, loses everything. I showed him how to set up a policy where the underlying asset that's collateral is not a volatile asset like the S&P. Like the reason we go to the S&P is because theoretically I can get a higher return, which you probably will. Life insurance is never going to make you rich. The S&P might get you there quicker, but it goes down. And if it goes down in the year that I need it, that's how we fail. I showed him how to use a policy. The policy is guaranteed to be worth more every single year. There is no volatility. So before I'm going to go use a margin account, let's make sure the underlying asset isn't volatile. That's just a simple principle of wealth. That makes sense?
I also would add to, like, you're going to borrow less on an uncertain asset. So if it's a stock, you're probably going to stay around 50 or less, 50% or less. But when you have a certainty asset that's guaranteed to grow, never depreciate in value or go down in value, you're going to be able to borrow up to 95% of that just because you see that this thing is not going to go down. It's contractually guaranteed.
I think it's funny when advisors can play with numbers to make a lot of things look attractive. And the consumer thinks the bigger number is always better, right? If my account value is higher, that's better. The lower the interest rate, the better. Well, we already discussed that. What if I have my lower interest rate shows up on my debt to income, shows up on my credit score, affects my credit score, affects my ability to get more loans, like cool, lower interest rate, but there's all these other things I didn't consider versus perhaps a higher interest rate with none of those features. Same thing when borrowing. The person who's going to win is the person who has choices.
Yep.
You're not forced to do the wrong thing at the wrong time.
Awesome. So let's bring up the last one, cash.
Well, cash is trash. Cash is not trash. Show me a billionaire that doesn't have millions in cash.
Exactly.
Now, I'm a huge believer in cash. The challenge is most people keep cash in a bank where it's only FDIC insured up to $250,000. It's exposed to creditors in a lawsuit. And the earnings rates stink. And the little rate that you do get is taxable as ordinary income. So I know someone, dude, personally that has $2 million in cash. Why? You think they're conservative? Go like this.
Maybe.
Yes.
Depends on how many assets they have.
Yeah. Okay. Net worth is like less than 5 million and 2 million in cash.
Oh, that's conservative.
That's very conservative. Yeah. Because they don't want to lose it. Okay. If I could show you a way to not lose money, guaranteed, that grows better, tax-free, off the radar screen of the IRS for income tax purposes, away from creditors, so you're creditor-protected. And oh, by the way, it comes with a long-term care benefit and a death benefit. So when you die, not if, your surviving spouse will get reimbursed for anything you enjoy while you're alive. Oh, but I heard life insurance was bad.
Yeah.
This is the problem. I used to have a coffee mug that says, "Don't confuse your Google search with my master's degree." So my point is cash is a great option. Like so much of like financial decisions are just, like you said, we think linear, but now that I know what I want or I can do something, should I? I know I want cash. Okay. Should I have cash? Well, what if you could get cash value? It might have a lot more benefits than just sitting in cash in the bank, because what's the bank doing with that cash? Is it sitting in the vault? Hell no.
It's moving.
Being lent out over and over. Yeah, that's how they're making money, is through the arbitrage. So why not just create your own bank with the cash? I'm all for it. But I think cash in cash accounts typically are not as effective as they could be.
And when you think about what a bank does, like they are creating guarantees for themselves. Like we're going back to these refinances, there's lots of underwriting. We're doing lots of inspections. We're spending I think we're spending $20,000 on just inspections on these properties for the bank to give us this loan.
You don't pay for that?
Oh, we pay for that, guaranteed. We pay for it ahead. So even if they tell me no afterwards, that 20 grand is still gone.
I love it.
But where I was going with that is that when you have 2 million, say that you're a friend that has $2 million, if we are able to keep it liquid, it's like that guy is making power moves. I mean, there's how many times do we come across something? This is what made me change my way of thinking is I came across a mobile home park that was 16 units and all I needed, it was a $400,000 purchase price, which is super cheap compared to today's numbers. It would be worth 1.6 million today, or maybe 1.4 because of where it was located. But all I needed is $100,000. And I remember having all this money tied up in my 401k, didn't really have the mentality to like say, just pull the money and don't worry about it. So I would have been financially independent in 2017 because if I only came up with $100,000, and what's the yield on becoming financially independent, being able to make your own schedule, and also like,
how do you calculate that?
Yeah, exactly. So what's the return on a $100,000 investment? And I can tell you that everyone listening to this podcast has that opportunity once a year. It's once a year that an opportunity shows up that if we had the capital, we would buy that asset. So that turns into where, like, how do we create a system that creates liquidity and make it able to where we're able to buy assets when no one else can?
100%, dude. Absolutely.
So before we end this recording, when we're going back to cash, we also have to understand when we spend money, like say if we pay cash for something, we're giving up the opportunity to earn interest. And that's really the difference between paying cash and using a cash value life insurance. When we borrow against it, we're leaving the asset growing and we're using the capital to go buy the asset ourselves compared to paying cash where we have given up the opportunity to earn interest.
Which is a real thing. I mean, you look at banks, they understand opportunity costs. Banks have billions in cash value life insurance for that exact reason. When they do tier one lending, they're using their cash value. So that's a great point. You're adding this safety net for your family and you're adding a control element that you can't get with other types of assets.
Awesome, man.
I love it. This is a great little episode. Glenn, thank you so much for hanging out and talking balance sheet items and how people can better flow their money so that they're in control and not at the mercy of the IRS and banks. Sweet, Glenn. All right, everybody, make sure you hit that subscribe button down below. And Glenn, I'll see you next week. We're going to talk about more fun things with life insurance.
Awesome. Thanks for having me.
Bye, buddy. See ya.
Thank you for listening to the Capitalizing Your Life podcast. Please rate, like, subscribe, leave a comment, and share with someone who you think would enjoy listening.